The systemic financial collapse would happen like this. People are so traumatized by what's happening with their homeowners insurance that they pull back on spending. That slows the economy down, tips it into a recession. And there are so many over-leveraged sectors out there that a recession leads to a brutal equities bear market, maybe a banking crisis. It's not clear at that point what is the fix. If bailing everybody out makes the dollar tank, then how does the government fix that? They've got to raise interest rates to protect the dollar, but then that craters a bunch of other over-leveraged financial institutions, which forces another bailout. And at some point, people just give up on the whole process.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 13th through January 20th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this returning guest who's watched on many channels. John Rubino is the founder of dollarcollapse.com. He also has his own substack, which we're going to find out more about later, and he writes articles about many topics that are of vital importance to those who are looking to be prepared and aware of the changes that are coming. John, thank you for joining us again here on Friday, January 17th, 2025.
Hey, Donegan, good to be back.
An article that you just put out this week really caught my attention, and I wanted to get you on to talk with us about it because we've been looking for a decade and a half almost to make sure that we're keeping people who are trying to take care of their individual households and families, finances, and their lives prepared and ahead of the changes that are happening in our landscape around us. And yet we've realized that many, many, many people have not heard from us, and we're only reaching one household at a time, that sort of thing, but that there are keepers of the keys to huge pools of people's nest eggs, insurance companies that are watching over their funds for such things as pension plans and endowments or retirements and insurance. One of those types of insurance that many people are directly affected by is their homeowners insurance, and we've had some rather scandalous failures of that. We've seen it in Florida, we've seen it in Hawaii, now we're seeing it in California. And you had written this article with a provocative thought that will homeowners insurance risks to the insurance companies be perhaps the stone that gets pulled out of the dam and starts the collapse of the financial edifice because of the huge dependencies on insurance companies and the increasing risks that they're facing. I wanted to give you a chance to kind of walk us through the key points of your article, and I'll try to bring up on the screen some of the wonderful charts that you included that give us visual indications of what some of those trends are that may not be obvious to most people, but that better become better understood if insurance companies are going to be able to keep themselves on the right side of things financially and continue to serve the populations. Because one of the things that we've talked about with our viewers and subscribers over the last couple of months is this idea of pension risk transfer, where insurance companies are picking up the bag on pension maintenance, where many private companies are letting go of that. They're washing their hands in this choppy and toppy market. They're saying, it's been a nice ride, but we're not going to take care of the pensions for our former employees or current employees. We're going to hand that off to insurance companies because insurance companies have those big deep pockets and they can always save the day. They're the cavalry that'll come in saving the day. In your article, you see this as a potential major risk of changes in our natural world, changes in climate, changes in risks from various sources that are impacting insurance companies. Can you take us down that path of that analysis that you did that lets people know how dire some of the insurance companies' risk postures currently are compared to where they were in the past?
Yeah, well, to understand today's world of insurance and real estate, we have to go back to post-World War II America and look at a couple of huge mistakes that we made or that we've been in the process of making since then. And one is tens of millions of Americans have been moving to the Sun Belt, whether it's the Southwest in the U.S. or the East Coast in Hurricane Alley. And we weren't paying attention to the fact that natural disasters are frequent and cyclical in those places. You have fires in Southern California and you have hurricanes in Florida and the rest of Hurricane Alley. And the more people we move there, the bigger the potential for disruption when these things hit. Miami is guaranteed at some point in the future a direct hit from a Cat 5 hurricane, and it's going to be brutal when it happens. And these fires that keep happening in Southern California and the rest of the Southwest, those are things that are natural and recurring. Now, at the same time we've been moving all these people into dangerous places, we've been debasing the currency via excessively easy monetary policy. And that makes financial asset prices go up. And houses are basically financial assets because you borrow money to buy them in most cases. So home prices have been soaring at the same time that more and more people are moving into these dangerous places. And that puts the insurance companies in a big bind because they're on the hook for replacing these multi-million-dollar houses when they burn down or whether they're destroyed by a hurricane or whatever, which means they have to raise their premiums. And things are getting so bad now. And I should say it's not because of climate change. It's not because any of these things are becoming more and more frequent. Necessarily. It's because people are moving into these places, which magnifies the danger and the cost of these recurring natural disasters. So yeah, the chart we have up now shows Miami's home prices. And you see that I'm eyeballing it, but it looks like they're about twice as high as they were at the peak of the real estate bubble in the 2000s. So you've got a massive amount of extremely expensive real estate right there, just waiting to be impaired and or destroyed by the next big hurricane. And with what's going on in Los Angeles right now, it's brutal. They've got high winds, which are spreading fires. I'm not sure anything is still burning now, but they've been burning for the last couple of weeks. And they've got a record number of houses that have burned down. And it's not just, one category of house. It's Pacific Palisades, which are extremely high priced, and other places which are more modest. They're all, they all burned down in the fires that just happened. And so what's happening with the insurance companies is that they're either raising their rates for homeowners insurance on both coasts to a level at which they can make money insuring all these incredibly expensive houses in places with frequent natural disasters, or they're just pulling out of those markets altogether. So they're leaving homeowners with a big problem in a lot of cases where even if they can get homeowners insurance, it's so expensive that it's debilitating. They can't keep their house if they insure their house, or they can't get insurance at all, which means a lot of houses are uninsurable and therefore unsellable. And we're talking tens of thousands, if not hundreds of thousands of people on both coasts who are in this kind of a position where they've got extremely expensive real estate that they can't insure. And so if they want to get out of it, they can't sell it. But if they stay in it, they're on the hook for the whole price of the thing when the next natural disaster destroys it. Now, with all of that happening, you get something called the reverse wealth effect, which is the wealth effect is basically the process by which when our stocks go up, we feel rich and smart, and we're more likely to take a nice vacation or buy a Tesla or whatever, and that stimulates the economy. But the reverse happens when we feel poor and stupid, which is the way a growing number of homeowners on the coasts feel right now. And they, therefore, are a lot less likely to spend the way they would have otherwise because they've got this giant gaping financial hole in their lives in the form of their house. And that could be enough to slow the economy down to tip us into recession in the next year. And we're so financially fragile because we've been borrowing so much money over the past 15 or so years to get us out of the Great Recession that a garden variety recession could easily metastasize into something much more dangerous. So it could well be that homeowners insurance is the catalyst that pushes us into a recession that then turns into something worse than the Great Recession of the previous decade. And who would have thought that homeowners insurance would be the catalyst? Because there are so many other things that seem more pressing, like us drifting into World War III or inflation remaining ahead of the Fed's target range, forcing interest rates up. Those things seem like the more logical catalysts. But now, after the LA fires, it's completely possible that homeowners insurance in particular and real estate in general turn out to be the thing that pushes us into the next recession.
Well, there are several dynamics there and several vectors. You mentioned inflation through currency debasement as the primary mechanism that drives that. That is directly related to this because it's driving up the inflated asset bubble in home prices, which then you have to insure those with higher and higher amounts of nominally of insurance coverage, et cetera. But the actual change in risk percentages, that sort of thing. I'm going to share another part of your article. It's quite eye-catching. Let me just bring this up right now, and it's the here we go. It's the increased. So this, looking from left to right, it's the number of states in which homeowners insurance was unprofitable in those years. So this is this phenomenon that you're describing, that it's becoming more and more difficult for insurance companies to turn a profit, to be able to operate on a continuous basis in more and more states. Any comments on that before we? Yeah,
that chart is from Charles Hugh Smith, by the way, who's doing great work on this subject. And it shows how tough the market for real estate or for real estate insurance is becoming. Insurers in a growing number of states just can't make any money writing policies on houses. And that leads them to do two things. One is to raise the rates, and the other is to just get out of those markets. And this kind of illustrates how dependent we are on something that was always just kind of background for most people, which is insurance. So much of a modern economy requires insurance to function because you can't borrow money unless there's some guarantee that the people you're borrowing from are going to get paid back. And your insurance is a big part of that guarantee. You can't own a house. You can't run a business. You can't have a car unless you can insure it. And the cost of all those variations on the theme of property insurance are going up. And the higher it goes, the more debilitating it is for big sections of the economy. And
you made me think about one more vector of risk here that may be policy driven, and that's the defund the police, stand down, et cetera. We had so many riots across the country in recent years, where I had business owners who are clients of mine calling me and saying, we're down there trying to protect our family's restaurant in downtown New York City, for example, and we can see the rioters coming down the street and they're breaking windows and they're looting and that sort of thing. And we're saying to the police, why don't you go stop them? And the police said, you shouldn't be here. You should leave. So those were the people who were trying to uphold their property rights were being told, no, we've been told to stand down. And so there were policy decisions made by governors, mayors, et cetera, all over the country that it isn't just natural disasters, it's unnatural disasters too.
Yeah, civil unrest is a big part of the real estate story because we basically we came down on a side in those riots, and it was the side of the rioters, which is to say the side that is opposed to small businesses in a lot of towns. And insurance companies are watching this, and they know that there's always something going on that could lead to civil unrest in the U.S. We're a deeply divided society in which a handful of people have most of the wealth, and the vast majority of other people are frustrated, and so they can take to the streets at any time for many different reasons. And if you're trying to insure a small business that's at street level, for instance, your policy has got to be becoming more expensive, right? Because the insurance companies, they're looking at this and they're thinking, wow, okay, what happens when there's the next police shooting or the next contested election or the next war where body bags start coming back and people don't want to accept it? And there are lots of reasons for people to hit the streets. And the government has shown itself to be unwilling to protect property at the expense of the rioters. So yeah, that's another thing that makes it hard to manage a business and manage property and insure it in a way that it's profitable. Unless you have ironclad guarantees of protection and insurance and manageable prices going forward, capitalism doesn't work. You need certain kinds of certainty in order to convince entrepreneurs to put themselves on the line and put their capital on the line to start businesses and run businesses that won't be profitable at first and that have to be profitable eventually if you want to keep them. And inflation is devastating for that whole concept of future certainty of income streams. But civil unrest is a big deal too, and natural disasters are a big deal. And we're handling all of it so badly that you put it all together, and what we would like to think of as a free market society based on private property and individual choice just doesn't work anymore. So that is a broader, longer term critique of what's going on out there. But it's a real one. Things are getting worse instead of better from the point of view of entrepreneurs. And if those guys shut down, job growth stops. And then you have a society that just doesn't work at all. If we don't have a robust jobs market, we have a chaotic political system. And if we have a chaotic political system, we have a broken financial system at the upper levels. And it all feeds into basically the same process of us getting worse and worse at doing important things. We're losing confidence in our ability to create wealth. For a lot of different reasons. But it all points towards an economy that doesn't work, doesn't generate enough tax revenue, doesn't generate enough personal income, doesn't generate enough capital flowing into the financial markets. And so, to put it in a very general sense, we're starting to look like Europe. Europe is a mess because they made some very fundamental mistakes, different mistakes for each country, but all accumulating in a sense that the EU might not even be able to hold together going forward. And, sometimes in the U.S. we're smug about us being better run than lots of other countries, but that's not always the case, and it's increasingly not the case at all that we're well run. So yeah.
I wanted to bring up one more chart that you had in there, and frankly, let me just bring it up right now. You showed a number of natural disasters, the cost of them, and there's several interesting things. One is it's unescapable when you look at this chart, and I'd like you to walk us through it, is that over the last several decades, it looks like there's been an increasing cost of disaster events. And then in the title, it says CPI adjusted, which is very interesting to both you and us and our viewers, because there's been frequent talk about whether the CPI accurately reflects the true nominal inflation, or if it's inadequately expressing it, and if that, how much of that is revealed in this analysis. In other words, how much are we seeing actually a physical change here versus how much are we seeing that the CPI doesn't cover the debasement of the currency? But the other thing that occurs to me, if you could, is that as governments tend to lie about things and come up with spurious ways of cooking the books and statistics, eventually there's somewhere you can't hide, you can't sweep it under the rug. We've had a lot of questionable medical declarations happening in the past 4 years, and yet now we're hearing from, for example, undertakers. We had a sheriff ex-sheriff from California who owns a mortuary, and talking to us about you can't hide what the morticians and the undertakers are uncovering in the wake of the medical things that have happened in the past couple of years. And then this is an example of the cost of damage, and you think pretty soon you can't hide this stuff from the actuarials and the insurance companies, because they're the ones that have to pick up the bill. Can you talk to us about what you saw in this chart and what it tells you?
Yeah, this chart shows a growing number of billion-dollar natural disasters, and clearly the number are increasing. And you might infer from that, well, that's climate change, but you don't need human-driven climate change to get a chart like this. All you really need is inflation that isn't adequately reflected in the official numbers, like you said, and more and more people moving into disaster-prone places. Because, there have been natural disasters since the beginning of time, but they weren't billion-dollar natural disasters because we didn't have $1 billion worth of property in those places. Now, the more people we put there, the more houses we build, the more cars, expensive cars, in the case of Southern California and South Florida. In other words, the more expensive property that we put in the way of these disasters, the more billion-dollar disasters that we have. So, it's important to look at why these things are happening. And if you look at, for instance, the frequency of hurricanes that touch the U.S., they haven't really risen over the past 100 years. Same thing with wildfires. The acreage burned in Southwest wildfires is actually going down. Well, it's actually going up lately in the last decade, but it's gone down dramatically in the last century. So it's not like there are more natural disasters. The important thing to understand is that these natural disasters are more expensive because we're putting ourselves in the path of them. And I think that's the big public policy mistake. Well, the two, obviously, inflation is a horrendous public policy mistake, but tens of millions of people moving into the path of natural disasters is inherently super expensive, and that's what we've been doing. So it isn't clear how you reverse this trend, because it's not like 10 million people are going to move out of California. Some people are moving out of California, obviously, and the stuff that's happening now will cause more people to move. But that's a multi-decade process to get back down to where we were in, say, the 1950s in Southern California. And people are still moving into Florida really aggressively. So that trend hasn't even plateaued yet. It's going to, because Florida is perceived to be a more successful place, and it is way better run than California. There's no doubt about that. But Florida and Texas, big parts of which are also in Hurricane Alley, are still attracting a lot of people for, good reasons in the moment, because they're well-run places with a lot of sunshine and reasonable tax laws, et cetera, et cetera. So they're better places to live than where a lot of people are moving out of. But the price of that is rising, more expensive natural disasters going forward, and the insurance problems that flow from that. Because one solution eventually, or perceived solution, is going to be that these states take over the insurance industry from private insurers who don't want to be there anymore. So you'll have a government homeowners insurance plan, which you have in a lot of states. But that doesn't fix the problem of incredibly expensive real estate being destroyed by periodic natural disasters. That just shifts the bill from one group to another. So it leaves the insurance companies don't have to pay off, but taxpayers do. And if you want to see a state go from well-run to badly run in a hurry, one quick way to achieve that is to have the state become the insurer of last resort for real estate. And Florida and California are in real danger of having that be their only available public policy option regarding insurance. And then boom, there's no way that taxes don't go through the roof when that happens. and regulations, because they will try to regulate their way out of these disasters, and that won't work either. So, that's one of the slippery slopes that we're on right now, that will make even well-run states badly run in the future. And, it's not clear where we go when Texas and Florida are no longer good places to move to. It's that there aren't a long list of places that can hold that many people where people can move to. So we'll see. But it looks like we have more problems than solutions in the near term as far as insurance in Sunbelt states goes.
One of the provocative statements that you ended the article with was, after kind of walking through these various risk factors and the trends, is, could this become a trigger for a systemic financial collapse? Can you touch on that as far as the role that insurance companies play in our current financial world?
Yeah. The systemic financial collapse would happen like this. People are so traumatized by what's happening with their homeowners insurance that they pull back on spending. That slows the economy down, tips it into a recession. And there are so many over-leveraged sectors out there that a recession leads to a brutal equities bear market, maybe a banking crisis. You and I have talked quite a few times about commercial real estate tanking, especially office buildings, that impacts local and regional banks, and leads to a run on the several thousand local and regional banks out there that hold a lot of commercial real estate paper. That forces the government to bail out this big sector, and then people see another multi-trillion-dollar bailout. And remember what happened in 2022 when inflation was almost double digits, or actually in real terms was definitely double digits. And then they act accordingly. They sell their bonds. They shift into real assets that causes inflation in that sector. And then this recession and bear market metastasize into something like the Great Depression, or something like the early stages of Weimar Germany, where government's bailing out everybody in sight with newly created currency, tanks the money, and drives everybody's cost of living up. That's when you get into really serious financial crisis territory, because it's not clear at that point what is the fix. If bailing everybody out makes the dollar tank, then how does the government fix that? They've got to raise interest rates to protect the dollar, but then that craters a bunch of other over-leveraged financial institutions, which forces another bailout, and at some point people just give up on the whole process. And I think that's what we're risking right now by borrowing as much money as we're borrowing. Government debt is going parabolic. It's straight up. September and October were the two biggest Septembers and Octobers for government debt ever. And this is not we're not at war or anything. We're not in any kind of a crisis. We're in, more or less peacetime. And we're still running these kinds of deficits. So we're taking ourselves in the direction of some kind of a gigantic financial crisis. And then, as we started this talk, it just becomes a question of what the catalyst is. And it could easily this time around be insurance.
It's like a house of cards, and then there are very many moving parts all around there, any of which, and this is when you and I first met in person at the first Liberty Mastermind Symposium in Dallas, Texas. I think that you said that on the main stage. You said there are an amazing number of things that could go wrong, and almost any of them could upset the whole system, talking about the fragility of our current financial edifice. And I guess I feel near and dear to part of it because the county that I live in is the fastest growing county in the country right now in Central Florida. And our little neck of the woods here is surrounded by dozens of developments that all just got approved by the various townships and counties and city councils and everything. So they were going to be putting in tens of thousands of additional homes and condos and apartments all around us here. And it's exactly the same dynamic that you were just describing of what seems to be a mega trend of even when the book Megatrends came out decades ago, California, Texas, and Florida were identified in there as the states that were likely to see massive influxes of people, moving there, and that does cause strain on a lot of things, and this is one of them. John, for people who want to follow, I promised we'd give people a chance to know about your Substack, where you write frequently about important topics such as this. How can they get connected?
Rubino.substack.com, and the newsletter that I publish there is about actionable advice for the stuff that you and I talked about today. In other words, okay, this is coming. What do you do about it? And so far, so good.
Well, I'm glad that you've made that transition. Now, you also have written books in the past, so people want to pick up the book that you wrote most recently. That was?
Yeah, that's an interesting story because Gold Money's James Turk and I co-wrote a book called The Money Bubble back in 2014 that turned out to be so early that it's just now becoming timely. Like the predictions are just now starting to happen. So even though
that's what happens when you put two prescient people together and
with nobody to tell them, hey, you need to not be too early with this. Yeah. But yeah, so that book actually is kind of timely still. It's available on Amazon.com and other places, but it's basically talking about what's happening right now.
So people who join your Substack can get access to the article that we just went through in some overview. But again, you write multiple times per week about topics like this, and then you get down into the weeds of what people can do actionable. And all of that's about preparedness. And you never need to apologize about being early in preparedness. That's one of the most well-known statements of preparedness is I'd rather be 7 years early than 1 day late. And it's true. If people there's time. It takes time to adjust your thinking. It takes time to adjust your plans. I've learned through my own life, it's not easy to move. And if you're going to relocate, if you're going to shift where your food is coming from, if you're going to change your diet, change your lifestyle, you get healthier, whatever, you need to start that because it's never too early, but it could be too late and you don't want that. John, we're grateful for your presence always here on Liberty and Finance. And folks, if you don't want to miss a single episode with John Rubino or any of our guests, make sure you're on our free mailing list. Just go to our website, libertyandfinance.com, put in your email address, click submit, and you'll get a confirming email. Once you confirm, then you'll get every interview that we do with all of our guests, 1 email per day, and our weekly specials. You won't miss a thing. John, thank you again for joining us on Liberty and Finance.
Thanks, Doug. Talk to you soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for January 13th through January 20th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.